The recent autumn statement certainly presented us with some planning challenges here at Thomas & Thomas. We've been racking our brains to work out exactly what the impact might be upon your portfolio. Now, I'm joined today by Norman. Norman has very kindly agreed to be one of our typical clients. Norman has got a £200,000 collective investment account portfolio, or CIA. This is not to be confused with his ISA portfolio, which is completely exempt from the recent changes. So we're going to talk about the situation as it currently is. So here, Norman is looking a bit sad. As you can see, no expense spared here in this wonderful production. So Norman is a bit sad and worried, aren't you, Norman? And the reason that Norman is so worried is because he's heard about all these changes. So at the moment, his CIA is worth £200,000. He benefits from 4 planning things that we can use currently to help him. The first thing we can do is ISA wrap £20,000 or more per tax year of his CIA, thus reducing the size of it. The second thing we can do is use his generous capital gains tax or CGT allowance of £12,300 per tax year. This means all the rebalancing and counteracting of portfolio drift and bed and ISA work that we do should be covered currently within this allowance. Norman also has a £2,000 dividend allowance. That tends to cover all of the bits of income that come off those lower risk income funds. And finally, there's a £1,000 interest allowance for those bond funds. So at the moment, things have been fairly straightforward. Now, we conducted a bit of analysis here at Thomas & Thomas, and we ran back through our clients and we looked to see what the average sort of capital gain is in a year. Now, we're not talking here about the average portfolio growth. That would be far more. What we're talking about is the average amount of units that get sold within a client's portfolio if the portfolio were worth £200,000. We found that that number is roughly £3,000 per tax year of capital gains realised. In other words, the bits that we have to sell, either to counteract portfolio drift or even for a small bits of withdrawals to cover an ISA, etc. With regards to the dividends, we found that the average dividends were about £1,250 per tax year. Now again, this varies because for a lower risk client, they'll have more income bearing funds, so there could be a greater amount. For a higher risk client, there may be a lot less income bearing funds. Nonetheless, the situation at the moment is that Norman's capital gains tax allowance more than covers the likely capital gains that he's going to get, and his dividend allowance more than covers the amount of dividends that he's likely to get. But the reason poor Norman is worried is because of these new rule changes. Now, using this extremely expensive paper plate, I've now written down what we can expect in the new world from April 2024. So from April 2024, Norman will still have use of that £20,000 ISA allowance, no changes there. He also, we think, will still have the interest allowance of £1,000, so no changes there. But the major changes are in the middle. We can see that capital gains tax has been greatly reduced from £12,300 to just £3,000. And the dividend allowance has been slashed from £2,000 to just £500. This is a big worry for Norman because he's worried that he's going to pay whacking amounts of tax. So let's just think about what that tax would actually be. We would have, if there was a capital gain, let's just say it's double the average, £6,000 of realised gains in the tax year. Well, okay, if Norman's a basic rate taxpayer, he's going to pay 10% tax on the difference over £3,000. So that's roughly £300. With regards to dividends, it's even more interesting. If he's got the average dividend of 1,250 of little bits of units that have been paid out and then reinvested, then that would be over the new £500 allowance. But the tax bill would be broadly in line of about £65. So it's not really a huge amount to worry about. The real thing for Norman is the hassle factor, as I would call it. It's the fact that Norman's going to need to do a tax return in some way to report these tiny gains to the revenue. Now, Norman could get a relative to help him or go online himself and complete a tax return using the consolidated tax voucher that he will get from his platform around about May every year. They give him the numbers to enter, so he could do it himself. But if he was worried, he could call in the services of an accountant. Now, we canvassed 3 reputable accountants that we use ourselves in South Wales, and we asked them to quote for helping poor Norman here with his problem. And they reckoned that they would charge around about £350 on average to help Norman with his tax return. Now, there's a fair point that that's probably higher than the amount of actual tax that Norman could pay, but there is a chance that the accountant may be able to use their professional knowledge to save Norman some money on his tax anyway. So it could be money well spent. So if we just take that away a minute, looking really forward, in honesty, in essence, the situation for Norman is probably not as bad as he thought. And I can see we've put a smile back on Norman's face. He's happier now, so that's fantastic. But what if Norman were to decide that he didn't want to pay for an accountant and he didn't want to complete a tax return? What options are available to him? Well, the first thing he could do is he could actually ISA wrap existing funds. Now, I've got here a very, very good example. Here is the CIA for our lovely Norman. He can use £20,000 allowances every single tax year to gradually take down the size of his CIA, meaning that there's less and less there in the actual CIA to be caught for tax. That's the first thing that he could do. But the second thing that Norman could do is he could get himself a lovely new Lego wife. That's the other option for you, Norman. And then what he could do is he could decide to split his CIA with his life partner, not you, accountant. I'll just take you out of the picture a minute, throw you over there. So he's able to split the funds, and then of course, Mrs. Norman and himself can use their ISA allowances on a regular basis to very quickly actually start to erode down the amount that's in the taxable CIA. So this is also another idea. If, however, Norman decides he doesn't want to get married and he doesn't want to use an accountant or do a tax return, the other options available to Norman could be that he considers wrapping his funds within a pension, or he could even wrap the funds within a life assurance bond. Now, in doing this, he could trigger other capital gains tax issues. So this is specialist advice, and I don't have enough Lego pieces available today to show you this. But Norman, rest assured, we can help you. So I hope that today you've enjoyed this short video about the tax changes. The real takeaways from this are maximise your ISA allowance. It's more valuable and important than ever. And make sure you speak to us. If you've got a CIA that's like Norman's worth over £200,000, speak to us fairly soon before we get to the April 2024 point so that we can start to perhaps make some planning changes. Oh, Norman, put it down, will you? It seems like Norman's made his tax planning changes and is going for the marriage option. Anyway, that's all from Norman, and that's all from us here at Thomas & Thomas. As ever, we're here when you need us. All the best.